So today we're going to be continuing with Chapter 1 exercises. Last time we were going over how each of these transactions impact different parts of the accounting equation and different accounts. So for transaction H, Chris Clark withdrew $2,000 from the business for personal use. So this is the opposite of an investment in the business by the owner. This is an owner withdrawal or a dividend. So this is going to be a reduction in owner's equity because they're taking money out of the business. And then what's the other account that's going to be impacted by this? Exactly, cash. So we have cash decreasing by $2,000 and then drawing, which is a temporary equity account for the year, that's going to be reduced by $2,000. A summary of everything that's happened so far, and this is what your homework is going to look like. You're going to be filling this out for a list of transactions. Our ending cash is $5,900, and you can see all of the transactions that we've done, all of the fees that got earned. This is just for exercise purposes, but these transactions are what we went over on Tuesday. Now we'll go over the types of transactions affecting owner's equity, which is owners putting money into the business, taking money out of the business, and then revenue and expenses, which is the business making money or spending money. And then that combines into the net income of the business. Now, net income is revenues minus expenses. There was a question earlier this week in the online class as to calculating owner with the net income for the year. Net income does not include owner's withdrawals. If an owner withdraws the money from the business, that's not included in net income. That's not on the income statement because the business still made money. Net income is how much money did the business make this year. Owner's withdrawals decrease owner's equity, but they don't decrease net income because the business still made that money. The owner just took it out. So for Charles to buy $89,000 in land for cash for the business, what would the effect be to cash? Yep, I heard B, I heard decrease, and then land would increase. That's correct. So Captivating Your Audience is a motivational consulting business operated by Edith. At the end of the period, assets are $2.45 million, liabilities are $1.18 million. Determine each of these independently. So owner's equity, we would determine by subtracting assets minus liabilities. We don't need to go into the exact amounts on these because there are a lot of exercises we have to get through today. And I do really want to get into the details on each of the financial statements because that can be quite a lot to cover. So to calculate if assets increased by 8,000, to calculate these, you would just add one part of the accounting equation, right? Assets went up by 825,000, liabilities went up by 515,000. The difference between that, 310,000, that's the increase to owner's equity. So then you would add that to the initial owner's equity that you calculated in Part A, and then you would know the owner's equity accounting for those changes. And it's the same deal for each of these. For letter E, you can calculate the net loss, assuming that they did not withdraw or additionally invest any other money in the business. The net income would be the change in owner's equity over the year. So it's really just sort of a big algebra equation using the assumptions of the accounting equation, and you can determine all of these amounts. And you can see the exact algebra here. The slides are posted online if you want to go over this exercise again. What is the effect on each of the three elements for each of these exercises? So the owner invests additional cash in the business. That's going to be an increase to the assets, and then also to owner's equity. Paid cash for business expenses. Yep, decrease cash and assets, and then also, yep, decrease the equity. And then withdrawing cash for personal use is the same. Purchasing supplies on account. What would this be? Yep, exactly. Increasing both assets and liabilities, and then receiving cash for services. Yep, an increase to cash, increase to revenue, which is an owner's equity account. We've already gone through a number of these exercises. I think we should move on, skip ahead just a little bit. So for number one, receiving cash from the owner as an additional investment in the business. Is this C? And then number two is purchasing supplies for cash. Yep, that would be A, increasing an asset by decreasing another asset. Paid rent for July, that's E, a decrease in an asset and a decrease to owner's equity because you're paying rent with your cash. Advertising expense, that's also E because it's an expense. I really just wanted to go over purchase supplies for cash as an increase to one asset, decrease to another asset. That's a key thing that I wanted to cover with these exercises here. Okay, so going over each one of these, each of these transactions will, except transaction 5, impacts net income. So transaction 1 is provided catering services for cash. That's going to increase fees earned, which is a revenue account, increases net income. The purchase of land for cash does not impact net income. I don't know why it says except transaction 5, but the land does not impact net income because you're increasing one asset, decreasing another asset by purchasing the land for cash. The payment of cash for expenses, you have a reduction in cash and a reduction in owner's equity via expenses. Purchase of supplies on account for $1,100. That's going to increase your accounts payable, which is a liability account because you owe that money to your suppliers. Paying cash to owners for personal use, that's an owner withdrawal from the business, and that's going to reduce your owner's equity, but it's also not going to impact your net income. Paying cash to creditors, that reduces the liability from accounts payable and also reduces your cash, no impact to net income. And then a recognition of the cost of supplies used. This is going to reduce your supply account. It's like when you do inventory and you realize, oh no, we're out of markers. Then you reduce that and you would reduce owner's equity via supplies expense or something like that. So what is the net increase in cash at the end of the month? You can see the beginning balance and the ending balance, and that would be the net increase in cash. This is important for something like the statement of cash flows because you know how much cash should be changing. And so when you're going through the homework and you're thinking, why doesn't this statement of cash flows balance? You can know how much is it supposed to change? What's your net change in cash supposed to be? And you can look for, okay, what am I missing? Where is the mistake? How do I make this statement balance? And what is the increase in owner's equity over the month? 1780, and that is the changes, right? Adding up all of the changes, the 71,000, the 47,000, and the 5,000 together, and that's your change in owner's equity. And then the net income is your revenues minus your expenses. How much was retained in the business? So that's your change in owner. The amount retained in the business is your net income minus any withdrawals by the owner, which would be the net income we calculated before of 22,800 minus the 5,000 that the owner took out of the business. During the month-end close or the period-end close at the end of the year, when we will change the retained earnings, the drawing accounts, fees earned, expenses, those accounts show the activity that happened over the year. But at the end of the year, on the balance sheet, they show up in what's called a retained earnings account. We'll go over that more in future chapters, but that essentially shows how much money has the business made over its lifetime that has been reinvested and stayed within the business. And that keeps our accounting equation in balance for the balance sheet. So you have your paid in capital, and then at the end of the year, on the balance sheet, in the equity section of the balance sheet, you would have your paid in capital or common stock or owner's capital of 117,500, and then you would have 17,800 of retained earnings in this case. And that would show up on your balance sheet. After all the financial transactions are recorded, we create what's called the financial statements of the company. And that's the full end product of financial accounting, is to create the financial statements. And that includes the income statement, statement of owner's equity, the balance sheet, and the statement of cash flows. And by the end of today and throughout the homework and quizzes, you'll be able to create all of these financial statements based on the transactions of the business. The income statement is a summary of the revenue and expenses for a period of time, which is also why it's important that revenue and expense accounts are over the year or the month or the quarter that the report is for. The statement of owner's equity shows the changes in the owner's equity. So you're going to have the beginning owner's equity, the withdrawals, the investments, and your net income, and then the ending owner's equity. The balance sheet has all your assets, liabilities, and owner's equity, and it'll list all the financial statement line items, which usually are all of your accounts, but sometimes multiple accounts will be grouped into one. In this case, for the purpose of this chapter, not. All of your accounts will appear as a line item on the balance sheet if they're an asset, liability, or equity account. The statement of cash flows shows how did cash change throughout the year. It's 3 sections: cash from operations, financing activities, investing activities, and we talked about those on Tuesday, what the difference between the activities are. So one key thing about the balance sheet is it is a snapshot in time. It captures what are the assets, liabilities, and equity as of the end of the year. And that's important to note because the balance sheet says November 30th, FY23. The income statement says for the month ended November FY23. So that naming convention is important because the balance sheet is a period in time, and then all the other statements show changes over time. So as you can see, the balance sheet has cash, supplies, land, accounts payable, Chris Clark Capital, and then the statement of cash flows has the cash that you receive from customers, the cash that you pay to customers, the cash paid for land, owner's investment, owner withdrawals. And the income statement has all your revenues, all your expenses, and then the statement of owner's equity has the changes to equity, which is investment in the business, and then your net income, and then the withdrawals. This appears to be the same slide. So the income statement shows your net income or earnings. That's also what's referred to as the bottom line, because the bottom line of the income statement is your net income. And if your revenues were more than your expenses and the business lost money, then it would be net loss instead of net earnings for the year. And the statement of owner's equity shows the changes in owner's equity over the year. You have to prepare it before the balance sheet so that you can know. And there's an order to how do you prepare these financial statements. And this is the order that you prepare them in. So the income statement, at the end of the income statement, you have your net income. Your net income goes on the statement of equity. So you have to prepare the income statement to know your net income before you prepare the statement of equity. Now your ending equity goes on your balance sheet. So you have to prepare that to know what your total liabilities and owner's equity will be. And then the balance sheet has your cash, and that net change in cash goes on your statement of cash flows. So you need to prepare the balance sheet before the statement of cash flows. The balance sheet has the assets, liabilities, owner's equity at a certain period of time, and it's shown vertically the order of the accounts is how quickly can these assets be converted to cash. So the top account on the balance sheet is always cash. And then after that, it's usually accounts receivable, because that's the cash that you're about to collect from your customers, and then supplies or prepaid expenses or things like that. And then as the assets get more long-term, they go farther down on the balance sheet. And so, long-term assets like investments or land or property, plant, and equipment, those would be lower on the balance sheet. And then the liabilities are the same. So the assets are going to be on top, then liabilities. Liabilities are also listed generally in the order that they're going to be paid. So accounts payable would be first, and then say you have more long-term debt, that would be further down the line. And then there's also, for each of these, you're going to list total assets and then total liabilities and owner's equity. There's like subtotals that you'll also have to calculate and display. And then the statement of cash flows it shows what happened to cash this period. And it is honestly one of the most intriguing of the financial statements, because you can figure out where did the money actually come from and where did it go. There's less accounting tricks that you can play with it. So if a business is making all this revenue, but the customers haven't paid yet, that's important to know. Is the business going to run out of money before they collect the cash from their customers? Where is their cash actually coming from? Are they adding a whole bunch of new owners or new investments all the time? Because that, as a new investor in the business, can be somewhat concerning. If they're constantly needing money from the people that own the business and you invest in the business, either you're going to have to keep putting up money for this business, or someone else's, and your ownership stake in the company is going to decrease. So that's the kind of things that really can come to light on the statement of cash flows. It really gets into the meat of like what's going on with this business. But there's 3 sections to the activities that are shown. Operating activities is the meat of the business. It's getting payments from customers, paying out to your employees, to your suppliers, things like that. And there's multiple methods of displaying it. In this chapter, we're going to be using the direct method, which is cash received from customers, cash paid for expenses. But with the whole algebra of how you figure these things out, you can also start with net income and then take out the parts that were non-cash and put in other parts that were cash and things like that. But for this purposes, we're just going to keep it simple. We're just going to say cash received from customers, cash paid for expenses. The investing activities are the acquisition and sale of long-term assets, buying property, buying, fixed asset like a new car for the business, or land, something that's going to be permanent or more than a year investments. And then financing activities are payments to and from owners, and also taking out or paying back loans. That's going to go in your financing activities. Important to note, but not for this chapter, is that if you're making the initial borrowing of money from the bank would be a financing activity. The money that you get from the bank would be cash received from financing activities. The interest payments would be an operating activity because they're an expense of the business. But actually repaying the loan when it's due, the principal balance on the loan, that would be a financing activity. Paying back the loan is a financing activity. Making the interest expense would be an operating activity. So for the interrelationship between the income statement of owner's equity, you need the net income to put on the statement of owner's equity, because it increases your owner or decreases your owner's equity depending on whether the business made or lost money. The statement of owner's equity in the balance sheet, the ending owner's equity, that's going to show up on the balance sheet. And the balance sheet and the statement of cash flows, the change in cash is going to appear on the balance sheet. And also that preparing and looking at the beginning and ending balance sheet is going to help you when you're trying to figure out what should go on the statement of cash flows. It's going to help you determine that, because if you have a whole bunch of new fixed assets on the balance sheet, there probably was some investing activity this year. If you have a whole bunch of new debt, there probably was some financing activity this year, that kind of thing. Yeah, the balance sheet is the connecting link between all of these financial statements, because it is the source of the accounting equation, assets equals liabilities plus owner's equity. When you're filling out the balance sheet, make sure to check, that your total assets equal your liabilities plus your owner's equity. If they don't, you're missing an account somewhere, something's placed wrong, that kind of thing. The cash is on the balance sheet. The net income goes to the equity, goes to the equity. Which financial statement would you want to review if you were interested in the net income of the business? Yep, the income statement. So the income statement for February indicates a net income of $1,750, and the owner withdrew $25,500. Would it be correct to say the business lost $8,000 during the month? Exactly, because an owner withdrawal is not an expense. But it is a decrease to owner's equity, but the business net income was $1,750. So for Amber, no additional owner investments were made. Total assets at the beginning of the year were 1.2 million. So in this example, it looks like equity increased throughout the year. That's fair to say, because your assets increased more than the liabilities did. If there was no additional owner investment during the year, that means that there was a net income for the business. If the owner withdrew 60,000, then that actually means that the business made even more money than this would assume, because equity went up even though the owner withdrew money from it. So then you can deduce that they made 60,000 more than the increase in the equity. If they invested additional 140,000 in the business, then you can assume that the increase, part of that increase in owner's equity was due to the additional investment, and so the income was less. And then if they invested and withdrew, you take the difference and then add that or subtract that from the difference in owner's equity to and from. So the initial increase is 350,000. If you have the owner withdrawals, right, they made another 410. Net income of 210 if that was actually an additional investment, right, that would decrease your net income. And an additional investment doesn't actually decrease your net income, but in this sort of algebraic analysis of the increase and decrease to your assets and liabilities, it does decrease, for the purpose of this problem, your net income, because you have to deduct that from the equity change. And then for an investment and a withdrawal, you have that. Okay, so what order would these appear on the balance sheet? So what would be the first what would be the first account on the balance sheet? Cash, exactly. And that's because they are ordered assets first, then liabilities, then equity in the order that they can be converted to cash. So cash is the first. Um, and then what would the next one be? Supplies, exactly. And then after that, equipment, exactly. And generally that's because equipment is more sellable or usable than land. And then land would be after that. And that's all the balance. Oh, that's all the assets. The first liability would be yep, because that's due first. I don't see any other. Oh, wages payable, that would be second. And then your equity account would come after that. And then on the income statement, so not the balance sheet, would be your revenues and your expenses. So it says prepare a statement of owner's equity for the month for June 30th. Really, the only thing that would have to be done for this to make it into a statement of owner's equity is put a minus sign in front of the withdrawals and then total it up at the end. That's really all you would have to do. And the ordering, the withdrawals would be last. So it has investment, net income, and then the withdrawals at the end, and then your total at the bottom, right? So and the parentheses in accounting indicate that it's a negative, although in your homework, just put a negative sign in front, and then I'm pretty sure Cengage will show it as a negative like that, but that's what that means, is subtract. Does anybody have any questions so far? I've been talking a lot, and I know I don't there's got to be, if you guys have any questions, just stop me if I'm just not making sense. Okay, so to prepare an income statement, once again, it's all sort of ordered out already. You would just add subtractions to all of the expenses. Um, there's oftentimes there is a subtotal that says total expenses, and then under that would say net income. And sometimes they're offset like this too, where you have all of these, and then it subtotals into the negative for the expenses, and then it all totals to your net income at the bottom. Generally, they're ordered in order from greatest expense coming first. As soon as we get into retail businesses that have cost for selling inventory, cost of sales is always going to show up first. And generally, that is the biggest expense of a retail business. But that is the presentation rule, so to speak. Missing accounts from the balance sheet. So this is more of that algebra that we can go over. So, we know that beginning and ending assets, beginning and ending equity for Freeman. We can calculate the change in equity and so the increase in owner's equity is 390,000, and then you would decrease that for the net income of the business, and then the 60,000 is the change that was due to additions and subtractions by the owner to the equity. And then you can say, okay, the owner withdrew 75,000, but the net impact of owners' contributions and withdrawals from the business was 60,000. So 135,000 must have been invested by the owner into the business. For calculating if we're missing what the revenue is, but we know the expenses and everything else, we calculate the same process, but trying to figure out what is net income. And in this case, you find the change in owner's equity, and then you add or subtract the additional investments and withdrawals by the owner. You get your net income, you subtract your expenses, or you add your expenses, and then you get what the revenue is, because you have your net income plus your expenses is your revenue. And this, as we went over at the beginning of class today, a lot of the like the quiz fill in the blank answers are questions like this, where they say, this is what happened during the year. Calculate what the net income was, or calculate what the revenue was based on everything else that happened. So the missing amounts from the balance sheet. This one is, okay, find total assets in this case at the beginning of the year. So you take your your equity at the end of the year, right? To calculate total assets, if you know liabilities and you know equity, is simple. You just take liabilities plus your equity. That's your assets. So we have to figure out what was the equity at the beginning of the year. So we know the equity at the end of the year. And then we add the decrease because of the net loss, because the loss hadn't happened yet at the beginning of the year. Add the withdrawal by the owner, and you get your owner's equity at the beginning of the year. Oh, well, and then you deduct the additional investment by the owner, and then, which actually, these two columns really should be switched, but this is just a screenshot from the textbook. And then you have your liability, your equity at the beginning of the year was 131,000. You add the 120 and you get 151 is what your assets should be at the beginning of the year. And then, this is just more of the same. But are you guys getting the process for how to figure these? Great. I'm just going to check for a moment how much slides we have left. Okay, we're in a pretty good spot. So Kyler owns and operates Ebony Interiors, prepare balance sheets, determine the amount of net income, and determine if the net income, assuming that an owner withdrawal of 50,000 was made. So to prepare the balance sheet, we're going to start with cash, then accounts receivable, supplies, and then subtotal it to total assets, and then accounts payable, and then your owner's equity of the capital. This is as of the beginning of the period. Now, the net income, assuming no additional investment, we can start preparing our balance sheet for the next period. And, adding up all of the assets, right? You can see assuming no additional investment, the end of the year is 975,000. And before it was 840,000. So the difference in that would be the net income for the year. Now, if you assume that there was a withdrawal of 50,000, that's just going to increase the net income by 50,000 because the owner's equity increased by that much, even though they withdrew money from the business. And so in this case, the net income would have been, 975 minus 840, which is like 135. If it wasn't, then it'd be 185 if they had this withdrawal. See, 185 for that. So now we're going to get into some analysis of, okay, we're looking at the balance sheet. We can see the ratios between liability, equity, and then what does that actually mean? What can that tell us about how stable is this business? How resilient are they going to be to bad times, essentially, or not making a lot of money? Banks will use especially the balance sheet to determine, can we lend this company more money? Sh Okay. Yeah, honestly, my brain doesn't remember these either. It all is sort of deriving them from the initial accounting equation, right? So you have your assets and your liabilities, and assets plus liabilities is equity, right? And so it's easiest if you just are right. If you like, I highly recommend that when you're doing the homework, when you're taking a quiz, have a piece of paper and write it out like this. And it'll become obvious when you write it, when you're writing out all the balance sheet items in order, where is something missing? And then you can fill in the blank by sort of doing the algebra. I can see if I can find a resource with some of the formulas like that, but that's my recommendation.
The resource like that, can you also find a resource for like specific vocab?
Ye-
Just have a list of them.
Yeah, for sure. Like the different financial statements or, okay, like asset, liability, investing, financing, operating, that kind of thing. Okay, I'll see what I can find. Any other questions? Cool. I'll see what I can do for some sort of resource or cheat sheet for you guys that sort of says a lot of the key points we've gone over with the relationship between the financials, what all the definitions are, that kind of thing. So for the ratios, so the ratio that we're going to talk about today is the liabilities to owner's equity. So you just take total liabilities and divide it by owner's equity. That's how you get that ratio. For example, Twitter, total liabilities of 5,000, 5,400, 7,900. Generally, these are going to be if you're looking at the financial statements of big public companies like that, the amounts are in millions. So in probably I would think Twitter would have like 5 billion in liabilities and then 7 billion in assets. Probably when they took, now it's around 40 or 50 billion, I think, because Elon Musk bought it for that much, but then gave all the debt to the company. It's the whole thing. But essentially, for the purpose of this, right, you would just divide the liabilities by the equity. And the point of the analysis that we do for this, right, is that the beginning of the year, Twitter had a liability to equity ratio of 0.68. Google had one of 0.44. And if a bank is looking at a business and determining, like, should we lend them more money? if they have more equity and less debt, there's more of a cushion for the bank because the losses of the business reduce the owner's equity, but not the liabilities, right? So there's more cushion for the business to lose money because they have more equity, more assets in relation to how much debt they actually have. So when a bank is looking at these ratios, generally they're more likely to lend to a business with a lower ratio than a higher ratio, especially at the end of the year. They're almost equal. A lot of times businesses will have really high ratios like these. And then also, it is possible for a business to have negative equity. And well, no, it's not possible for a business to have negative equity because they'd have to have negative assets, but negative retained earnings. That would be more accurate, right? So they could keep on contributing capital and then they keep on losing money. They still would have positive assets. They still would have positive liabilities and equity, but the ratio would keep getting larger, essentially. So let's say you have like 10 billion in assets. No, yeah, 10 billion in assets, 9 million liabilities, only 1 million in equity, your ratio would be 9. And there's really not much of a cushion there if things go wrong. Usually the ratio is only going to get that high when it's a fairly stable business, like a manufacturing business or a business that requires a lot of leverage, like an airline business to buy a lot of fixed assets, right? They have to borrow a lot of money in order to do that. So, this is the only ratio for this chapter. Um, there could be a quiz question about calculate the ratio of liabilities to owner's equity, and you would just put in liabilities divided by owner's equity, and that would be the answer. But to, more qualitatively, what does it mean? A higher number means the business has more debt compared to the equity of the owners in the business. And whether that's good or bad, from a bank, they really want to lend you money when you don't need it, right? So they're generally going to lend to lower numbers. But from an investor, when you're looking at this, it kind of depends on what industry you're in, whether it's good or bad, a higher or lower number. Because if it's a manufacturing company that's super stable, you might want to invest less in the business, borrow a whole bunch of money as the business, and then that's how it gets funded, right? So you're getting that same amount of profit for yourself with less of your own money. If it's more stable and the business can handle that kind of risk, then that's fine. And then if you see a lower number in that kind of a business, you might think, why aren't they taking enough risk? They could make more money if they took on more risk. If it's a really unstable business with a lot of debt, you might know to stay away because they might run out of money, not be able to pay back their creditors, and then they would require more money from the owners or they would go bankrupt, essentially. That's what happens when companies run out of money and go bankrupt is like either the business dies completely and stops existing or the owners have to contribute more money and generally that's what happens, or they sell off the assets to another business, right? But that's somebody paying money for those assets. The money goes to the banks, they get the leftover scraps, and it's more money that's going into the business. So we still have 10 minutes. Is there anything you guys want me to go over more? Maybe more on the financials, more things like that. Um, I think we can take a look at, I think we should take a look at some of the balance sheets of public companies. And I think that would be fun. Or is there a company What's like a big company that you guys want to take a look at today? Google, great. So this, and also everything is just out there on the internet for these public companies. And how you find all this information for the SEC, what every year annually, they have to publish what's called a 10K. That's their annual report. Quarterly, it's called a 10Q. For foreign companies, it's called something else, but they still have to file one if they're listed on a US stock market. But essentially, you look up Google 10K, and sometimes it's not the first result, but also sometimes it's in their investor relations. So you can look at all their earnings releases. And so for the whole fiscal year, look at the annual report. And this is the 110-page annual report for Google. I'm going to see if the 10K, I don't like all that formatting. My accounting brain likes this. It's going to look the same for every single public company. And there's an order to how the financial statements appear. It's always going to start with describing the business, the risk factors related to the business, and then a bunch of other random things that are just required by the SEC for businesses to report. At some point in the middle, right, they're going to have discussion. Management's going to give an explanation of what happened this year financially and operationally to the business, and then talk about risk. And then there's the financial statements. So, in case you're wondering why I'm sort of obsessed with these reports, this is my whole job, is reviewing all of these for big public companies. And then also I work on the audit software that supports the auditing of these kind of financial reports. So the easiest way to find the financial statements is to search Auditor Sense, because they're all required on the audit report. Google is audited by Ernst & Young. That's the only place that it's going to show up in the financials, and it's basically right there. You scroll a little bit and you'll get to the balance sheet. So, we can see that Google, right, it's all in order that we talked about before. So we have our cash and cash expenses, 24 billion in cash, another 86 billion in marketable securities, which is generally short-term commercial paper or treasury bills, things that are just going to give a little bit more than a savings account, but not like an interest that the bank is going to get, or that the bank is going to give them or something like that. And if it's less than 90 days due, it's going to be a cash equivalent for the business. So that's what they subtotal it into this cash equivalents. They've got their accounts receivable, other current assets, non-marketable securities. Oh, wait, yeah. Then deferred income taxes, property and equipment. And they're in order of how long-term these assets are. And then total assets of 400 billion. Then you've got your accounts payable, accrued compensation, which is similar to salaries payable, but that's also going to include like the vacation time accrual and things like that. Long-term debt, income taxes payable, operating. It's all the things that we've really been talking about. And then once you get to stockholders' equity, they'll list it out differently for each type of share class. And then, this is the things that we were talking about before. So the retained earnings or accumulated other incomprehensive income or loss. This is a more intermediate accounting topic, this accumulated other comprehensive income, but then the retained earnings, we will cover that in this course. And that's just the total amount of money that the business has made that has remained in the business, right? Income statement, revenues, expenses, and then net income. They divide it by the amount of shares. So that's the amount of income per share of the business for the years, and you can see it's actually decreased. That's kind of interesting, right? And then statement of equity, net income. Oh, this is comprehensive income. This is that other comprehensive income item. Here's the equity. Okay, right. So you have the beginning, and then you have your investments, and then your net income. Oh, they have it for they display it for 3 years at a time in these public companies. It's all regulated, like how this should look. And then cash flows. So you have your operating activities, investing activities, financing activities, and share buybacks will also appear as a financing activity because that's a payment back to the owners of the business. Yeah. Anybody have any questions on financial statements or?
A lot of like Google stuff, it looks like they have more income happening than any cost right now.
Yeah. Yeah, they have, this is all the adjustments to the net income for cash or non-cash items. But, every year their net income, their cash flow from operations is higher than their net income. And that's generally from non-cash expenses like depreciation. It's a big one. But also they keep on increasing. There's ways they can do it, right? It's like we can say why is it always bigger? They keep on increasing so it's depreciation and stock-based compensation. That's a big one, right? So they're paying their executives or other employees 19 billion a year in stock-based compensation. That's not a cash expense of the business. Google just essentially creates new shares, gives them to management, and that's an expense of the business because it's increasing the ownerships, like it's increasing the amount of owners of the business. So the existing owners of the business own less now of the business, right? But it didn't actually cost any cash to do that. So that would increase that's an increase to your operating cash flows because it's a non-cash expense, right? So in that case, expense would go up, owner's equity, I don't know what would happen. What would the accounts be in that? Yeah, the owner's equity issued of stock, like that would go up. Your expense would also go up, which would decrease your retained earnings, right? So it would be just changes in equity. There would be no assets or liabilities affected at all by this stock-based compensation. But yeah, I'll let you guys go 2 minutes early. I don't have anything more to say. But yeah, I hope that you found it interesting. That's how you look up the financials of public companies. They're all out there. Anoka Ramsey, Minnesota State's financials are out there on the internet. Most nonprofits are just sort of out there for you to research. It's pretty cool.